More on this, let's bring in Kathryn Rooney Vera, head of research and strategy over at Baltic. Kathryn, good to have you here this morning. So the Fed already under a ton of pressure already to whip the economy back into shape. So how potentially will these numbers factor into those plans, especially if maybe they're really bad this morning?
Right. Well, the Fed has a dual mandate explicitly, 2% inflation, which they changed to a target of an average of 2%, and full employment. We're already way above the 2% target, whether we average it or we call it a target, and we're already at full employment. Wage price spiral is a very real thing. That's, of course, when wages go higher, corporations, both big and small, have to increase the cost of the goods that they sell to compensate for higher wages. So we have dynamics that the Fed is concerned about. I would argue and have argued for a very long time that they are too late in considering this structural rather than a temporary phenomenon. It certainly is not temporary, and it's not attributable entirely to supply chain disruptions. This is a demand component. It's a very strong component, and we see both rents, we see healthcare, and we see wages going much higher. My concern now, Baker, is that we get the Fed is going to be hiking in an inevitably decelerating economy. So what does that mean? We get non-farm payrolls. Let's say we get a bad number. ADP came out really bad on Wednesday. Today, we're probably going to get a similarly decelerating number in terms of jobs generated for the last month. So where does that lead us? The Fed still has to hike. So I think what we're going to be hearing more and more, and at Baltic we've been saying this since last year, is the word stagflation. High inflation, decelerating growth. The Fed has to walk a very fine line now that they've delayed this rate tightening cycle for such an inordinate amount of time. They're going to have to walk a fine line in terms of hiking rates, not too aggressively, to not only just slow down the economy, it could actually stop economic growth. So they have to be very careful. My suspicion is that they're going to hike 25 basis points 3 times. I bet that if non-farm payrolls comes out ugly, if we get economic data that shows a steeper deceleration than what the market is currently expecting, which is our view at Baltic, then the Fed is not going to hike as much as the Bank of America's and Goldman Sachs are saying, which is 6 to 8 times this year, but rather 4 or fewer for the entirety of 2022.
Ooh, that's really interesting. If that's the case, what do you think that would do to the economy if you do see less than maybe 4 rate hikes this year? And do you think, let's just say if this number is really bad, is there a chance maybe that Jerome Powell hikes interest rates higher than a 1/4 percentage point here?
Well, if the number's really bad, if we get, lower non-farm payroll numbers than we would expect, which indicates a slowing of the economy, the market's going to probably, take it very positively, because it means that, the Fed is unlikely to, jack interest rates up 50 basis points in March, as some are dictating, or even more aggressively. If in fact we do either get a more serious market correction or a very steep economic deceleration, my bet is the Fed, backs up a little bit. And really anything can derail the Fed. The Fed can go from very dovish to very hawkish very quickly, and it can go from very hawkish to very dovish very quickly. So it could be, it could even be another variant. It could be a geopolitical event. It could be a market drop. It could be ugly economic data prints. So many things could keep the Fed from hiking rates so aggressively as the market has already priced in. So look, I think that if we get some negative numbers, the market's going to price in a more dovish Fed, which is equity positive.
You mentioned stagflation a moment ago. Are we already seeing that hitting the market already? Are there already signs that it's here?
Stagflation is generally defined as a deceleration in economic activity below potential growth rate. So potential growth in the United States is 2.5%. Last year, the U.S. economy, of course, developed a very, very, very robust, already developed economy, grew 6%. So we are going to see a deceleration. But my base case scenario is that we don't go below potential. I'm below consensus. Consensus is about 4% growth, which is actually really strong after 6% real GDP expansion last year. To grow another 4% this year is very, very bullish. I see 3%. So I don't think we're quite at stagflation, but I highlight it as a risk, Baker, because if the Fed does decide to get real on inflation after it's been giving inflation a pass for many months and discounting or underappreciating the risks that are inherent in both fiscal stimuli out the wazoo, right, and monetary stimulus, plus economic growth of 6%, plus record high equity markets. I mean, the Fed really underestimated the structural nature of inflation. Now they're taking it seriously. My point with stagflation is if the Fed decides to hike rates commensurate with their dual mandate, they have a dual mandate, it's full employment and it's 2% inflation. If they choose to do that, then we could get a steeper deceleration in economic activity, bringing us below potential while inflation remains above target. That is stagflation. The Fed wants to avoid it. My bet is they do.
Interesting analysis. Great to always have you here, Kathryn. Kathryn Rooney Vera, head of research and strategy over at Bulltech, joining us this morning.